Hey everyone, in this video we're going to analyze the stock of Coca-Cola and try to figure out whether it's a good value right now or not. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance. This channel is all about investing, so if you're into that, hit that subscribe button to check out my other videos. So while Coca-Cola is most known for their namesake, selling Coke, they actually have over 500 different brands they sell worldwide. Now, speaking of worldwide, here's a breakdown of Coke's operating income by geographic region. So you can see they only make about a quarter of their income for North America. So it's quite a global company and it offers quite some hedges against dollar devaluation, which we may be facing here in the US. So here are some details from Coke's balance sheet. It looks fairly healthy to me. A liabilities to total assets ratio of just about 80%. That's a bit high. But think about Coke's stage in their life cycle. They're definitely in the maturity stage. So companies like this typically have higher leverage. As for liquidity, both their current ratio and quick ratio are above 1. So I don't have a lot of concerns there. I will say they're not above 1 by very much. But this is very typical these days. A lot of CFOs like to manage these ratios and not let excess working capital sit by idly. Now, looking at Coke, they have a return on equity of close to 40%, and that consists of the following components here. The net income margin is 25%, which is pretty good. That means for every dollar of sales, they ultimately keep 25 cents in bottom line income. Asset turnover is 0.39, so for every dollar of assets they have, they generate 39 cents in sales every year. And the equity multiplier is just about 4. So the ROE is pretty impressive, around 40%, but consider that quite a bit of it comes from that equity multiplier. Here I have Coke's income statements for 2016 through 2019, and I use the trailing 12 months for 2020. So that's going to be the first 3 quarters of this year, 2020, plus the last quarter of 2019. And what we can see here is a pretty steady stream of revenue. It does bounce around a little bit, so overall, when you look at it, it does not appear to be growing. I don't like to see that, but it's fairly steady. And then when we look at the income stream, net income here at the bottom, that's pretty steady as well. I do see a little dip in the year 2017. Okay, so here's a vertical analysis. We have 5 years of income statement data for Coke. And what we've done here is taken all of the income statement items and just divided them by the revenue in that year. So you'll notice that revenue, of course, is always 100% of revenue. What we see here is that the net income margin, the impressive 24, close to 25% this year, is not necessarily something that we can expect to continue. And the reason I say that is that you look at the past 5 years, it's fluctuated from a low of about 3.5%, which was a bit of an anomaly. But you also see that you had a year where it was about 15%, 19%. So I'm not sure we can count on these strong margins going forward. One part that I do like to see is that gross profit seems to be a very consistent 60% of revenues. So for every dollar of sales you generate, you get to keep about 60 cents after paying for the actual cost of the product. That's a very healthy margin there. Where we start to lose money is these extremely high operating expenses. So here's the total amount of money Coke has paid out in dividends, that's in the orange, versus the amount of money they've given to shareholders in the form of share repurchases or buybacks. As you can see here, Coca-Cola is a heavy dividend payer and they don't do a lot of buybacks. So Coke's payout ratio is about 80%. Meaning out of all of the income they earn for the year, they pay about 80% of it out to shareholders. This is very high. And because of this, I think it's a good time to use the dividend discount model to value the company. Now, for smaller growth-oriented companies that pay hardly any dividends or none at all, the dividend discount model is not going to work very well. You're going to want to go with a theoretical dividend, the free cash flow to equity model. But in this case, for Coke, the dividend discount model is really perfect. And that's the model we're going to use. So because Coke pays out so much of their earnings as dividends, we can use the Gordon dividend model, where the price equals the dividend next period divided by the discount rate minus the growth rate. So next period's dividend is forecasted to be $1.64. So we got that one. The growth rate, according to the consensus analyst forecast on seekingalpha.com, is going to be 2.6% going forward. And finally, the discount rate, one of the trickiest inputs of them all. The idea here is that it needs to be at least the risk-free rate, and then we need to increase it because holding equities is riskier than holding T-bills. And the amount by which we increase it, it just depends on how risky of a company it is. For a company like Coca-Cola, I would go with about 6%, but I will adjust that number and see how the value changes. So if I plug those inputs into the model, we get a fair value of $48.24. That's using the 6% discount rate. Now, another way of interpreting that would be to say that if you paid $48.24 for Coke stock today, you are expected to earn a 6% return in the long run. Now, we can, of course, modify this discount rate and see how sensitive the value is. If we want to increase the equity premium here, maybe a 7% discount rate, the value would fall to $37.27. Again, the alternative interpretation of this, guys, is that you need to be paying $37.27 in order to get a 7% return on this stock. Let's change it to 5. To get a 5% return, you could buy Coke for as much as $68 right now, and you still get 5% on your money. Okay, let's put it back at 6%, and let's modify that estimated growth rate to see how sensitive the value is to changes in that growth rate for the dividends. 2.6% is not that optimistic, but let's just see what happens if we change it to 2%. So if we're off by a little bit, it really changes the value of the company, right? If Coke only grows at 2% long run, it's only worth $41. On the other hand, we could be more optimistic here. If Coke can even eke out, say, a 3.5% growth rate in dividends over time, we would actually have a fair value of $65. Compared to what Coke's trading for today, less than $50, you'd have quite a deal. Finally, let's look at the insider trading activity. We see that in the past 3-month period, we have 1 buy and 5 sells. The past 12 months, you get 17 buys and 45 sells. Let's see how many shares are involved here. So you can see over the past, especially over the past 3 months, quite some selling activity relative to the shares bought. And that is not something that I like to see. It makes me think that perhaps the insiders know something about the company's future that we do not, something negative. So is Coca-Cola a buy today? Well, I would have to say no. Insider trading data does not look positive, but even if you discount that, even if you say that, okay, insiders are just selling because they need to get some cash, even if we put that aside for a minute, we have to simply look at the financial statements and look at the numbers from our intrinsic value model. The company's intrinsic value, assuming reasonable estimates for growth and discount rate, is about exactly the value of the stock's price right now. As I make the video, the stock is trading at around $49, and the fair value is about $48. Now, when we played with the inputs to that model, we saw how the value could really shoot up if Coke can manage to increase its dividend by 3% or 3.5% per year instead of the estimated 2.6. But I got to be honest, I'm not very optimistic about that possibility. When you just look at the past 5 years of Coke's income statements, you don't really see a pattern of increasing income. At best, they're holding steady, and it's pretty rocky. So I usually like to recommend a stock, but let's not be overly optimistic. This one has serious risks, and you're probably just going to have a pretty meager return on it. There's not much upside as I can see it. So given the current price of about $49, I got to say it's a pass. All right, that's all I have for this video. I hope you guys liked it. If you did, hit that like button. It helps me a lot. Thank you.